today we are going to look at tax year end planning for the current tax year and some steps you can take before it ends on 5th of April 2023. This is in context of UK taxpayers except in Scotland for the tax year end 22-23. I'm sure you will agree that in the past year we have experienced more than usual number of changes in some of the tax bands and allowances. Tax has been very much in the headlines, hasn't it? So let's take a look at the changes introduced by the Chancellor in his autumn statement in November 2022 and what they could mean for your tax year end planning for 2022-23. The personal income tax allowances have been frozen for a further 2 years until 5th of April 2028. The level of income above which the higher rate of tax at 40% is payable is also frozen at 37,700 until 5th of April 2028. The level of income above which the 45% additional rate tax is payable has been reduced from 150,000 to 125,140 from April 2023. The dividend allowance, which is the amount of dividend you can get in a tax year without paying any income tax, is currently 2,000. This is reducing to 1,000 from 6th April 23 and again to 500 from April 2024. The capital gains tax annual exemption is currently 12,300, but this is reducing to 6,000 from 6th of April 23 and then again down to 3,000 from April 24. The inheritance tax nil rate band and residence nil rate band remain frozen at 325,000 and 175,000 respectively until April 2028. The good news is that the ISA contribution allowance still remains at 20,000 per annum and there's no reduction in the fundamentals of the pension tax regime. So all of that said, how much, if any, of those changes need to be factored into 2022-23 tax year end planning and 23-24 tax start planning? Well, it really depends on your circumstances. But giving sufficient thought to your tax year end planning as we approach the end of the tax year is especially important, given that we now know in advance of the next tax year and what some of those important tax changes are going to look like. By the way, the changes introduced by the Chancellor in his budget announcements on 15th of March 2023 are covered in a separate video, as these will not take effect at least until 6th of April 2023. So here are 7 top tips you could consider as part of your tax year end planning. Tip 1. If your income is 100,000 or more, you're already impacted by the gradual removal of personal allowance. Basically, for every £2 of your income over 100,000, £1 of the personal allowance of 12,570 is lost, and it's completely lost when your income crosses 125,140. So for income between these two bands, you're effectively paying 60% tax. The reduction in the additional rate band will no doubt mean that more individuals will find themselves paying more income tax as a result, and so there will be greater need for advice. The 3 main ways of reducing the impact of this is to make pension contribution, make charitable donations, or invest in certain investments which provide income tax relief against their income tax liability. Top tip 2. You should also ensure that you're maximizing the use of your income tax personal allowances. For example, personal savings allowance for savings income, or also dividend income allowance, which is currently 2,000 but will be of course reducing to 1,000 in April 23 and then to 500 from April 24. So restructuring your investments to maximize the use of your dividend allowance in the current tax year may be something to consider. Tip 3. If you're currently not able to use your personal allowance because your income is below the personal allowance, you may be able to transfer 10% of your personal allowance to your spouse or civil partner, provided that your spouse or civil partner pays tax at basic rate tax. This form of planning enables couples to save more in income tax between them. It's sometimes referred to as marriage allowance. Tip 4. Ensuring that your ISA subscriptions have been maximized where possible. Tip 5. Maximizing your pension annual allowances wherever possible. Of course, please bear in mind that pensions cannot be accessed until you're at least 55 years of age, and this is changing to 57 years of age from 6th April 2028. Tip 6. Consider using other tax efficient investments that can act as tax reducers. Tip 7. Another area to explore is the use of capital gains tax annual exemption, which is currently 12,300 but will be reducing to 6,000 from April 23 and then further to 3,000 from April 24. The reduction will mean more individuals will be subject to CGT, and so it is worth looking at current investments and seeking advice to ensure the annual exemption is fully used, as it cannot be carried forward to the following tax year. We have a separate video about capital gains tax planning. So in a world where tax is generally increasing, the value of tax attractive investments such as ISAs and pensions is even more important to recognize. There is still time to carry out a tax health check before the end of the tax year to ensure you are maximizing all your allowances and exemptions and to screen for any tax efficiencies that you could be missing out. We would be happy to help. Please get in touch with us using the details in the description. Thank you for watching.